Well, look, we consider the U.S. market as fully valued at this point. And the current valuation paradigm reflects the high degree of confidence in a pretty benign outcome for the U.S. economy in the next few quarters. As far as the U.S. election is concerned, I would say the market has, on the equity side, been rather reassured as betting odds have shifted in favor of candidate Donald Trump. The perception, rightly or wrongly, is that Kamala Harris would be less supportive for the economy. And conversely, that has affected the bond market. But I think on the bond side, there is also the realization that we have experienced a very unusual cycle this decade. The economy has been through an income-driven cycle as opposed to a debt or leverage-driven cycle of the kind we've seen in the early 90s, late 90s, or 07, 08. And in an income-driven cycle, the transmission of the unprecedented tightening of monetary policy in 2023 has been fundamentally different from previous historical precedents. So we have a situation today where the Fed is easing, as all the central banks do, at a time when financial assets are quite richly valued. The S&P 500 is at an all-time high. And very critically, private sector balance sheets are in a strong position. And you can ask yourself the question, if they drop rate too much too fast, if this is not going to trigger a new credit cycle at a time when the economy is operating at pretty close to full capacity.